Hi, this is Mayumi Arai with Nexa Mortgage. Welcome to Mortgage Pro Max channel. Today's topic is about a bridge loan. A bridge loan is a short-term financing option designed to help homeowners transition smoothly from one property to another. It's particularly useful when you want to buy a new home before selling your current one. Here's how it works. Key features: temporary financing. Bridge loans provide short term funds to cover the gap between buying a new home and selling your existing one. Equity based. These loans are typically secured against the equity in your current home, allowing you to access funds for the down payment on your new property. Flexible terms. Bridge loans usually have terms ranging from a few months to a year, giving you time to sell your current home without rushing. No monthly payments. In some cases, you may not need to make monthly payments on the bridge loan, as the loan is repaid once your current home is sold. Benefits: avoid contingencies, allows you to make a non-contingent offer on a new home, making your bid more attractive to sellers. Market flexibility provides the freedom to buy a new home without the pressure of selling your current one immediately. Considerations: interest rates. Bridge loans often come with higher interest rates due to their short-term nature. Closing costs. Be prepared for potential closing costs and fees associated with the loan. By understanding the benefits and requirements of a bridge loan, you can make informed decisions and enjoy a smoother transition to your new home. If you found this video helpful, give it a thumbs up and subscribe for more mortgage tips. Have questions? Drop them in the comments below. Thanks for watching and happy house hunting.